Welcome to Plead the Facts, presented by KI Legal. On today's episode, KI Legal co-founder Michael Iakovou is joined by Vasilios Markou, loan officer at Citizens Bank, to discuss residential mortgage financing trends in 2023.
Hey everybody, welcome back to Plead the Facts. I'm Mike, and again, Vas Markou here. I used to call him Vasilios, but now he goes by Vas. He keeps switching it on me, but Vas, thank you for joining. You know, we've known each other a long time. I think we both started our careers about the same time, and we've seen just a lot of good times, and now we're seeing some different times. I'm not going to call them bad times, but I think a switch from the status quo that most people our generation have been used to over the past 15 years or so. And, again, I'm excited for this conversation. You're kind of like your boots on the ground. You see how buyers are working and, kind of underwriting deals specifically in New York City and Long Island. So, with that, what's like initial gut reactions of where we are right now?
Oh, man. Well, thank you for having me here. Very excited to be here. It's an interesting time right now. Everyone thought that things were kind of crazy and all over the place with COVID. It was a turbulent market. Things were up in the air. COVID ended up being a very busy and good year, especially on residential and sales side. So I think the more interesting, crazy times are now. Last year, especially second half of the year, and this year, it's got a lot of people. A lot of people thought that we were kind of heading towards, home prices crashing, things going down, things slowing down, and the market's been resilient, man. I mean, demand has stabilized.
It's the inventory, right, or the lack thereof.
That's you hit it on the head. I mean, we could wrap up the podcast right now. I mean, that's exactly what it is inventory is. There's just not enough homes and too much demand right now.
Yeah.
You go back to your regular supply-demand economics. Too much demand, chasing too few products, and that's why prices have been where they're at, regardless of the rates and where interest rates are at now.
So how have banks, specifically who you work for, Citizens Bank, how have they responded to that market need? I mean, these prices, interest rates have gone up naturally because they've had to, right, with the Fed.
Right.
Although yesterday we did receive some good news that they didn't go for, I think, that was it their 11th straight rate hike or something like that.
Paused.
Yeah, there was a pause, and I read in the Wall Street Journal earlier this week that when they were kind of going back and forth, like, are they going to raise? Are they going to raise? Are they not going to raise? If they don't raise, historically, again, that's not guaranteed to happen this time, but 12 months from that non-raising date, that's when we'll start seeing cuts. That's historically what's happened. We don't know if that's going to happen. We're not Miss Cleo, but that's a good indicator, right?
Correct. Right. So the Fed is. It's been very fun and interesting to watch the Fed and their press conferences and what they say and what they don't say. I think right now, the Fed is done. I think if we see the data coming out in the next couple of weeks and it keeps going the trajectory that we're seeing, inflation is starting to cool off. Yes, not as quickly as they want, but if we keep going in that direction, I think there's no more reason for the Fed to keep hiking.
Yes, the consumer price index is essentially half of where it was just a couple months ago. Right.
I think the key, though, for the Fed, and a lot of people were saying, and the same thing that I was telling my clients, because it's what the Fed would come out and say, is they're worried about inflation. That was the whole story last year. This year, their tone has changed. I think once the Fed sees initial jobless claims increase a little bit more, I think they'll then start to change their dialogue. So are they done? I think so, yes. They're saying they're going to reserve the right to maybe hike 2 other times. I think that's them just maybe saving face to say, we're serious on inflation and this and that. But personally, I don't know if we're going to see another 2.
And you mentioned jobless claims, and I think a lot of it is, it's an interesting thing to analyze. You have New York City, right? And then you have the rest of this country, and then you have industries, right? You have hospitality, hotels, finance, tech, right? Something else that I read just the other day. During COVID, right, the shutdown, tech was the biggest proponent of work from home.
Right.
Now tech is the biggest proponent of everybody back in the office. Why is that? It's because, the powers that be finally realized that companies make less money, right? Workers are less efficient.
Right.
when they work from home. There's no team building. There's no continuity. We're social creatures. People like to work with people, see them, and the next 6 months I think are going to be big. We're going to see a big shift. I mean, do you agree with that?
I agree. I mean, you brought up a good point because I saw more articles too about, now that we've had people working from home for, before it used to be in the beginning,
and
right?
the other one,
weeks and weeks and weeks.
The other one I read was that people are lonely now.
Right, that's what I was. So now
what do you think was going to happen?
We're going from weeks and weeks to working from home to now months to months to now years. Now they're talking about psychological effects that it might, have on people. I mean, I'm not a therapist or a psychologist. I don't know, but look at commercial real estate and what's going on right now with,
oh my Lord,
values and all these businesses. So there's obviously a need, and you can argue both sides of the line there. But as far as, look, things slowed down for banks too. Residential lending, all types of lending is not what it was a year or two ago with rates being so low. So when I say that, inventory is low and things are still crazy now, things obviously have slowed down a bit for the banks, but you still have that, I'm going to open houses on weekends and you're still getting 30, 40 people lining up to come see the homes. Not because rates are super low and they want to take advantage of this and their buying power has increased. It's because they have no other options for other homes.
Yeah.
People still need to buy, and their options are less.
Yeah.
So, that's why I think it's been a very interesting last 6 to 12 months, because we have rates going up, we have all these things happening. We had a record drop also in applications and purchases too when the rates did peak, right? But that happened probably end of last year. October, November, we saw our highest interest rates. Rates were crossing into the 7s.
They came down a little bit, right? Afterwards.
They came down a little bit, but forget about what rates were doing. The monthly prints of November, December, January, February were now showing volume and demand was going back up again as far as people applying for mortgages. So now we see that the future data is showing increases here, regardless of where the rates were at. Yes, rates came down a little bit, but that demand was starting to stabilize, even in an environment when people were like, oh, as soon as rates go into the 5s, no one's going to be buying anymore, right?
Yeah, I know.
And there's a little, psychological,
surprise,
right? There's psychological stuff that goes into it too, because again, I had buyers that, I was talking to that were so used to 2s and 3s. The lowest rate I ever quoted was a 1.75 on a 5-year ARM, during the lowest of the lows.
So, you bring up another good point, right? All of these potential sellers, right? They're going to sell. They're locked in on a 30-year fix that's sub 3, right? And they're going to sell, all the upside that they're going to get from the built-in equity on their home, but then they need to go live somewhere, right? So they're going to buy something that's gone up tremendously in value,
right?
And they're also going to buy it pursuant to a 6 or 7 or 8 handle. So it's just
right. No one's going to sell to be homeless. That doesn't make sense. And to your point too, and another interesting thing that I read too, because people love comparing 2008, 2009 to COVID and post-COVID and what we're looking at now in the market. 2008, 2009, you had same things: jobless claims going up, initial jobless claims going up. Foreclosures were going up, short sales were going up. When that happened, though, people were almost forced to sell because they couldn't afford their mortgage payment, they couldn't afford their stuff.
Yeah.
When you get into foreclosure, when you get a short sale, when you have a modification, you usually can't get financing right after that too, right?
Sure.
So you have people selling homes because of the situation that they're in, or because of the market or a recession, and now they can't really buy anything else. COVID happens, right? Rates are low. Sellers are maybe now looking to upgrade or move out from cities and stuff, right? So all these people that were selling homes were also turning around and buying homes, right? So that demand is you're selling a home, but now you're buying a home as well. The inventory is that's the story of 2022 and 2023 is inventory.
I think back in 2008 when we had the residential mortgage crisis, it was siloed to residential mortgages, whereas now a lot of people are talking about corporate debt, commercial real estate being distressed, and everyone's like, oh, well, it's just siloed to that. No, it's not, because, and as I'm hearing you speak, I'm just writing down notes, right? If jobless claims go up because corporations can't afford to pay these people because people are spending less money or whatever, inflation's up, whatever the 1,000 reasons are,
right?
That means New York City or New York State, prices need to come down because people are just not going to be able to afford these homes, right? And then maybe they start moving out of New York.
Right.
It's the point I'm trying to make is it's not just fixated on one vertical. We're all interrelated here.
Absolutely. I mean, and that's even to assume that prices are going to go down, right? With jobs going, jobless claims going up. If the demand is still there, people are still buying, and there's not enough inventory, you're not really going to see. We saw prices start to soften a little bit with the raising of the rates and the Fed funds rate going up and all these stuff, all this stuff coming out with the Fed.
Yeah.
But not a lot. You saw it soften for a little bit. Maybe earlier this year, January, February, people were getting some deals. But then what happened? Again, we go into the spring purchase season, and yes, that's been a little bit more delayed every year, but you have people overbidding again. I have people again that are waiving appraisal, waiving inspections, waiving this and that just to win the bid.
So it's so funny. I mean,
right.
When I first started as a young lawyer, I mean, these were things that you just did not agree to.
Right.
And now it's just like if you do put your foot down and actually do your job as a lawyer, they're like, you're a deal killer. It's like, I'm not a deal killer. I'm just trying to protect my client.
It's true, and especially on like the luxury or high end. I mean, if you were not waiving your mortgage contingency or appraisal or inspection, I mean, they weren't even taking your offer seriously.
Yeah.
Because they expect everyone, they're putting the money down, they've got the financing locked in, they don't got to worry about it. And on top of that, you're going up against cash offers. Cash offers have never been higher than, in the last year or so.
Where are they getting all this cash?
I don't know. I would love to know that because
we do.
I need to find out.
Yeah.
Right. But that's the other thing is, so cash offers have become, very high for two reasons. Because A, financing is expensive now.
Sure.
So why am I going to go get a higher rate if I have the cash?
Yeah, I mean, you put your cash in now, you have that equity, and then when prices, when interest rates comes down, you can just maybe refi cash out and move on to the next deal.
Right. But then the second reason too is because demand is so still high, and you're competing against all these other offers. Cash is king. Cash usually gets the deal sealed.
Always. So, next 6 to 12 months.
As far as like the
market.
Residential rates, I think next. So, if the Fed is truly done and we don't see any more increases,
is this like a springboard and we just keep going?
I think what buyers are going to see. I think if you're on the fence to buy now, if rates start going down, it's going to get crazier again because you're going to have other people that maybe sat on the sidelines and like are waiting for rates to fall. They're going to maybe now enter back into the fold. You're also going to see prices then, because then what happens when rates come down? People's purchasing power goes up. They're going to start overbidding and again. So next 6 to 12 months, I think if rates soften a little bit, it'll be a busy season again, and we'll see prices elevated. If rates still continue to go up, if the Fed does happen to raise again and rates will go up, it's going to really depend on what happens to demand. If demand is stable, we might not see much happen. If there's an impact to demand, then you could see inventory start to slowly increase. You could see prices start to soften a little bit too, but we're not going to have any kind of crash, I don't think.
So, personally, what type of clients do you mostly work with? Are they people?
A whole range. I'm dealing with guys that are, buying their first home, putting the minimum down. I'm dealing with, hedge fund guys that are purchasing, their third, vacation home, or, investors that are building. So it's a really wide range. I love starting out with the first time home buyers because I like the education piece of it and, teaching and kind of sharing knowledge.
So on those first time home buyers who may be more often than not squeezed out of the market, do you see any macro level trends in terms of where they're buying? I mean, because you're doing deals all across the city and Long Island all the way out to the Hamptons, I'm assuming, right?
That's an interesting point. So before, people were looking for area, like I want to be in this area at this price point. Now it's I want to be at this price point regardless of the area.
Yeah.
So I see
that's commentary on like the work from home thing, or?
It is, because sometimes people don't have to worry about necessarily where they're commuting from or how far they're commuting. So if they're buying in Suffolk or they're buying close to the city, it doesn't really matter to them. So I see that people are broadening their scope of where they're looking at, and focusing more on price versus like I want to be in this area, or I want to be in this school district, or I want to be close to my job. So The buyers that are first-time buyers that are putting low down payments, I think they're getting pushed out of further out to Long Island as far as our market. But I think generally speaking, it's more they're looking at price point and where the prices are still affordable to them.
Yeah, North Shore, South Shore.
North Shore is blowing up, man. North Shore, I work with a group of agents up in like the Huntington area, and it's very sought after. There's not a lot of inventory, but there's a lot of demand. I mean, their weekly views and clicks on their properties are higher than a lot of the other.
What are some of those neighborhoods? I mean, I think that's that type of insight is something, because everybody can say, oh, you have less money, relative to other people. You're not going to live in Port Washington. You're going to move out to, I'm just making this up, Northport or something like that.
Northport, Huntington, Lloyd Harbor, Cold Spring Harbor, and then if you move a little bit further south, obviously Jericho, those areas, Syosset. The school district places have always been popular, for families, but those are kind of like the North Shore kind of key areas that people look at. Northport too. Northport's really
a lot of good commerce out there.
Yeah. Well, there's a lot of, you're relatively close to the city for your commute if you're driving or taking transportation, and you can get a little bit more property versus like on the South Shore.
Sure.
Taxes are not terrible, but you get a decent bang for your buck compared to like other areas.
I mean, it's I think the landscape is changing. People's appetites for being more east of the city has grown for all those reasons that you said.
Especially for like the jumbo portfolio market.
Talk to us about that.
So typically on our jumbo loans,
this is the good stuff.
Yeah, typically in our jumbo portfolio loans, we were in the past, with exception, able to go up to 50% debt to income ratio.
Okay.
Sometimes even higher. We were also able to go, and still actually are, up on higher loan to values, meaning less money down for the client. So we were actually one of the very few that were doing low down payment on these jumbo loans.
You say low, meaning sub 20?
Yeah.
Okay.
So we can do on loan amounts below $1 million. We can still do 5% down if it's a portfolio loan.
There you go.
Yeah.
Portfolio means it's going to stay on the books. The bank isn't packaging it up and selling it.
Exactly. And we're still making those exceptions too, even on loan amounts up to $2-3 million. We can do like 10-15% down.
That's great.
But where they at Citizens, at least, where we kind of changed things up, where we were looking a little bit less for exceptions on the debt to income ratio. So we wanted, instead of going up to that 50, our standard is 43. Maybe we'll allow an exception up to 48, depending on the compensating factors. Generally speaking, though, a lot of lenders now have pulled back on that less than 20% down in that jumbo portfolio space. So if you're at like another big name bank trying to do a portfolio loan, I've heard a lot of people, at least that are coming and calling me, they're requiring 20 to 25% down.
Yeah, and I mean, listen, jumbo is anything in excess of 749?
726 now, for 726 and change on a one family or one unit.
Yeah, so I mean, let's say it's $1 million property, 25% down naturally is $250,000 plus your closing costs, make it another 50, give or take. So you're coming out of pocket $300,000.
Right.
Whereas if you can do something at 10%, it's a lot more attractive.
Exactly. So, and again, assuming you win the deal, right? Because if you're putting in an offer with 10% down, maybe the seller might not like that deal so much, but we have that flexibility where we're still offering that. But generally, from what I've seen out there, banks are getting tighter. Credit score requirements, down payment requirements. They are making these changes just because they're kind of worried about the landscape in the future. But again, this stuff has all kind of been around though before, right?
Yeah.
Ever since 2008, 2009, all these rules were kind of put in place. So credit has been tight in that sense for residential people. You can't just go out and get a loan just because you want one, and they're not going to give you a loan just because you want one.
Yeah.
But things have gotten a little bit tighter in the last year or so.
I think a good tip though, right? If you do want to go with some financing, sellers pushing back, the agents pushing back, the attorneys pushing back, saying, we're not going to agree to any financing contingencies. If you have a conversation with you though in advance and you're pre-qualified, pre-screened, I can get this deal done for you. You may feel more comfortable waiving that contingency, and whether or not you go out and get financing, right? It can be built into the contract where it's not, the deal isn't contingent on you getting financing, but you can still utilize financing.
Right.
At the end of the day, sellers don't care where the money comes from, if it's from your pocket or from Citizens. They just want to know that you're going to close.
Right.
So that's, I feel like, a good workaround.
That's what a lot of people are doing now is you're getting pre-approved, and in some cases going through the underwriting process without a contract, or as much as you can without a contract,
Sure.
so that your finances and credit are approved and your assets, and then it's just matching you up with the property. So that's one thing that lenders and people are doing to kind of feel a little bit safer, as to like, okay, I'll waive my mortgage contingency because I know I've got the financing locked. It's just a question of appraisal and title, and if they want to waive those things.
Are the rates bumping up or down once you get into the jumbo territory? Because I have to imagine most of your loans are jumbo.
Yeah, so it's interesting because for a long time, jumbo rates or portfolio rates were a little bit better than conforming rates. And then what happened? We had the banking stress and crisis earlier this year, where you had three large banks.
Something happened earlier this year?
Yeah. So you had the downfall of these large banks, and again, that we could do a whole other subject of that and how that happened. But again, it caused some stress in the markets and impacted portfolio bank lending. Banks have gotten a little bit more conservative with that stuff. So typically right now, yes, portfolio rates are usually a little bit lower than a regular conforming rate, but there's been a lot of volatility there just with what's happening with all like the banking crisis stuff.
Got it. So what would you say percentage-wise your business is? Residential lending, commercial?
I do straight up all residential lending at Citizens.
Got it.
I mean, anything that comes commercial my way. I mean, I have family in the business that I'll refer to, or other friends and
so
colleagues.
What have you learned from your family, just having grown up in this business? Because this is a legacy guy, right? What are you, like second or third generation in the lending business?
Second generation in the lending business. If anything, I love to call my dad, and because he's been in the business for over 30 years. So when I talk to him about this, and rates are
he
terrible.
He's like, it's fine.
Yeah, this is nothing to him. He most of the time our conversations end with him saying to me, stop crying on the phone. This is nothing. So it's a good balance, and it's invaluable, information to have that to lean on. Someone as seasoned as him, but. He kind of like brings it back in where, then I turn around and I'm telling other colleagues, because they'll come and they'll say, this is rough, or, rates or this and that. And I spit that same stuff out back to them, like, quit being a bribery.
And you look so wise.
Right?
Right?
Exactly. They're like, wow, look at this guy. Like, he's 10 years younger than me.
Cool as a cucumber.
Right. So if they watch this, now you know my secret. It's not me. It's my father projecting through me.
That's great. What are the... I guess the goals over the next 12 months for you?
So I've gotten very busy in construction financing.
Let's hear about it.
So construction, especially now with people that are sitting on properties that they may have already owned, or maybe they didn't buy something during COVID or the last year or so. Instead of maybe going out and buying something, they may want to renovate their existing home. So construction financing has blown up a little bit more in the last year or so.
So how are you structuring those deals on, like, say, an acquisition loan with a construction piece to it?
So you can do it one of two ways. If you're buying a property, we will give you the money to purchase the property and then finance the construction.
Okay.
So it's your purchase price of the home.
Now, when you say finance the construction, you mean renovation. You don't mean sticks up development, right?
We can do that too.
Okay.
We can do that too. So depending on what they want, people can come to us and say, I want to buy this plot of land and buy and build a property there. We can do that financing. We can't finance just the land, but we will help you purchase the land and then finance the build of construction.
Okay.
If you have land already that you own and you want to build there, we can help you do that too. We can do the refinance side and the purchase side. So if you're purchasing, let's say you're buying the home for $1 million and you want to renovate and renovate, let's say, another $500,000 on that, your acquisition would be 1.5.
Got it.
Your down payment and loan to value and everything is then based on that 1.5 amount.
Got it.
So it's a great product, I got to say too, and which is one of the reasons why it's so popular, because not a lot of lenders are doing the construction financing right now.
No.
At least on the residential side. There are maybe one or two guys out there that are competitive, but I got to say our underwriting process is a lot simpler from what I've heard.
Have you seen, and I don't know if you would know this, but I know one of the biggest complaints we had from contractors and builders was just the price of product.
Right.
I'm assuming a lot of those things have stabilized over the last 12 months.
Yeah, I mean,
Down.
look at the builder stocks in the last couple of days. I mean, they're all reporting crazy revenue, and their stock prices are going up. So I think builders are, cost of materials and goods have definitely come down for them. So they're doing a little bit more. Again, depending on how they do the contract, most of the time, they negotiate that with their buyer or the person doing the renovation.
So these new builds, does Citizens require them to be primary residencies, or can they be single-family rentals?
We'll do a construction on a primary or a second home.
Got it.
But we're not helping the builder build a home. We're helping the end user, the buyer, either buy and renovate or build and construct a property, and then it'll convert to a regular, traditional loan after the construction phase.
Got it.
During that period of time, you're only paying interest. So whatever you've, drawn at that time or taken out to do your build, whatever you have lent to you at that point in time, you're just paying interest on that until the final, appraisal is done and completed, and then it converts to a traditional loan.
Is the money pre-funded, or it just sits kind of like a credit line?
It's pre-funded, so you're applying to a loan for a specific loan amount. We need the contract price, we need the draw schedule, we need to see the construction costs from the builder.
Yeah.
Right. So we see all that stuff. So we're going to have a fixed price now. There's times when things can adjust after closing, where things might be up, go a little higher or go a little lower. I'm not going to say it doesn't happen, but usually they'll then work that out with the bank post-closing.
Got it.
But it's a great product. And then the other thing too, which is great, which people love, is we also give the owner the money. So a lot of these banks and a lot of these other lenders out there will sometimes finance the construction and then cut the checks directly to the builder. We will allow the owner actually to get the checks to them, and then you can go out and pay the builder, whatever.
Yeah, you're the GC at that point, right?
Exactly. Which people like too, because again, if you don't need to use the full amount, you can either return it to the bank and then you have less of a loan.
And is the bank amenable to, I guess, first-time builders? Because I know a lot of banks are, they get some trepidation around that.
Yeah, so again, we're more looking at the financing of the, we're qualifying the buyer themselves off the loan amount and stuff. We do a vetting of the builder, and we do want to see, a track record and history. I'm not going to say that builders haven't got rejected in the past, but typically 9 times out of 10, if they've built a home or have some type of experience, usually they're not having a problem on the financing side.
And then last question on this, is this product, is this only for single family homes, or can this be used, say, like on a multifamily, a 2-3?
Right now it's just for single family.
Got it.
I have heard exceptions for multifamily if it's let's say a doctor's home with maybe an office or something.
Okay.
Those are very few and far between, especially now in this environment. I don't know if they're making any exceptions like that, but there are talks to maybe extend it to multifamily, but the risk appetite, I don't know if the bank has that right now.
Does Citizens run any of those specialty loan programs for professionals, doctors, lawyers, dentists?
We have we call it the medical professional, so it's any doctor or dentist. They have those programs available. Honestly, the benefit there, I really think, for people is not necessarily that you get a better rate or a better product. A little bit more flexibility in the guidelines. So less money down. If you have student loans, which a lot of these doctors, coming out of college do have student loans, the guidelines for how they qualify them are a little bit different. So there's a little bit more flexibility in what they can qualify for with those.
All right. Last thing, again, you kind of touched on it. Next 12 months, bullish, bearish. What are your thoughts?
I'm always bullish. I've never really been bearish with anything.
Answer.
Yeah, I'm regardless of my outlook. And if it turns to be not true, I kind of look to see where the trends are going. So I'm always optimistic. I think, like I said, if rates continue, I don't know if they'll drop necessarily to where people were predicting this year to be the low 5s, but I think if they kind of head in that trajectory. And into next year, I mean, the Fed already is kind of forecasting that. I know, although they didn't say they were cutting rates, their forecast assumes that there's a rate cut because of what their target Fed funds rate is. So I think if rates go down, I think we'll have a busier 2024 for sure.
I hope so, and I'm looking forward to doing some deals together.
Absolutely.
Markou, Vasilios, all three. Legacy loan officer here. It was great having you on. Gave me some really good insight into what's going on. I hope the hope everybody here takes some things away from this conversation as well. Best way to contact you?
Cell phone, email. I mean, we'll post that stuff.
Yeah, we'll post it.
Want to drop the link below? One of those things. I always wanted to do that.
We'll do. Zoe's laughing off camera. Zoe's our head of marketing. Anyways, everybody, have a nice weekend, and we'll talk to you guys soon.